So, so yesterday we were talking about uh, alternative investments, and essentially we've done in terms of alternative investments. We've spoken about different types of investments, including investing in land or REITs. So that's direct investments versus indirect investments in land, and then we spoke about investing in commodities and different ways that you can invest in commodities, including through derivatives. And then we didn't speak about it, but we have mentioned before that you have different types of like private equity funds, hedge funds. These also fall under the alternative investment category. And the newer advent for these traditional types of alternative investment funds like private equity and hedge funds are crowdfunding, where you're now looking at virtual platforms and decentralization, right? So that's where right now the world is moving a lot towards decentralization because since the global financial crisis of 2008, you have seen a lot of trust being lost in central bank systems and government systems and the traditional way of doing business, right? So with that, and with the advent of online or the mass acceptance of online, you're seeing more decentralized systems coming into play. How much they will remain in play, we will have to see. But certainly the format is changing, right? And that's where we saw crowdfunding as one decentralized way, where we look at raising funds now instead of going, you're looking at the end user going through a business like a private equity company. You go directly to the end investor. You directly tap the end investor. So earlier in those days, that's why you had these intermediaries like banks and investment banks, and you had all these people to help people connect, because there was no other way for you to know whether I had money or not, or whether I would lend money or not. But when you have these online platforms, it's easier to have interactions directly. So in that sense, that's why we call these systems more decentralized. Another fund type system that became popular during COVID actually is SPACs, special purpose acquisition companies. So I told you SPACs and crowdfunding can also be defined here under funds as well. So crowdfunding we spoke about, and we'll just speak about SPACs right now, special purpose acquisition companies. So they are again kind of like private equity investments, right? In a different manner. So what happens in a SPAC? Also, we call this like a blank check company or a blind pool company. Here, you float. You essentially you do an IPO in the stock market for a company that has nothing inside it. Okay. So you ask investors to come and invest in a company that has no business at all. It has no business. The only objective of that company is to find another company that is doing business and to acquire it. So what are you asking? You're coming with an IPO and you're telling investors, I am looking for you to fund me so that I can go and acquire another company. Sometimes at the time of the IPO itself, you will know what company this company is planned to buy. Sometimes you will not. Most of the time, you will not, right? So that kind of looks like, you can understand, a private equity structure. What happens in a private equity structure? You have the private equity company. You have the general partner, right, who takes on the risk and does the day-to-day operations of the fund. You have the general partner will then go and invite people to come and invest in the fund. And these people are essentially the limited partners or the investors of the fund. General partner is also an investor of the fund. He also is an investor, but he is also not just the investor. He is the person who manages the fund or sponsors the fund, right? Versus the limited partners are essentially just investors. They just put the money, while general partner puts the entrepreneurship plus the money. And you take this money and you go and find places to invest, depending on whether you're a venture capital company or a private equity buyout or a LBO, leverage buyout, right, type of company, depending on what space you are in, what category of companies that you're looking to invest in, you will find different companies to invest in. If you're a leveraged buyout type of company or a private equity buyout type of company, then you wouldn't be investing in multiple companies. You would invest in a single company. And then the returns from these companies are expected to flow back to the investors in the form of either dividends, which is very unlikely in the form of dividends because these are all growth companies. Most of these companies are growth companies, right? So they want the money. Very few companies will pay dividends. Some companies will, because private equity investors also want a portion of their steady income back, right? So some companies will pay dividends or will be asked to pay dividends. But that's what happens in a private equity transaction, whether it's through venture capital or private equity buyout or private equity, right? This is what will happen through a private equity transaction. And at some point, you will sell these companies or sell it in terms of an IPO or an M&A transaction. And you will get rid of your portfolio, essentially. Sometimes there won't be companies left to sell because the company would have gone bankrupt. Sometimes you will sell it to the owner back again because the owner has first right of refusal. And you will earn a profit inside the PE firm, which gets distributed to these investors, and there is a long holding period, right? This is a PE company. Now, in a SPAC, it is kind of similar. It is not too different, right? The SPAC also has a sponsor. It is kind of a trust type of vehicle that is created. It's a special purpose vehicle. Right? It's a special purpose vehicle, an SPV. Just like in securitizations, we create SPVs. This is a special purpose vehicle, an SPV that is created. It's a specially created special purpose acquisition company. It is only created for the purpose of acquiring another company, right? And you will have a sponsor for this acquisition that acts like the general partner, because it is not a partnership, right? But he will do the types of things a general partner does, other than the fact that this is not a partnership. And the sponsor will then bring this company to the public through an IPO. So the sponsor is not going to find all these investors, limited partners through privately approaching them, right? Usually in private equity companies, these investors are accredited investors, right? You have to have certain amounts of high net worth to be able to invest. Every single person is not allowed to invest because private equity investments are risky. So in a SPAC, what will happen is the sponsor will come to the public through an IPO and will ask investors to invest in this SPAC. So during the IPO, the investors will invest in this SPAC. They will give money. So they act like the limited partners. They are not limited partners, right? It's not a partnership, but they act like so this is the private equity transaction versus a SPAC transaction. Investors are like the limited partners in that private equity transaction. So they are the ones who give the money to the company. Sponsor also, just like the GP, sponsor also invests a little bit of money in the SPAC. So now you have this SPV a special purpose vehicle that has money. And this special purpose vehicle will look around for a company to invest in. It has collected money from investors for the purpose of investing in another company. So at the time the investors give money, they don't know where this company is going to invest. Just like in a private equity transaction, when you give the money to the GP, you don't know. The GP might have a couple of companies lined up just to show you, like, for example, this is the type of investments I'm going to make, right? Because these are my credentials, just to give some comfort level. But in a SPAC, generally you invest in a single company, and the investors won't know most of the time what that company is going to be. So those are kind of similarities between the SPAC and the private equity company. Now, what will the sponsor do once he gets this money? He will hunt around for a company to invest in. Once he finds this company that he's going to invest in, the target company, what he will do is he will merge with that target company. The SPAC will buy out the target company and they will merge together, right? They will merge together. So unlike private equity, where you're making investments in multiple different firms, in a SPAC, what will happen is now you will have the target company being taken over by the SPAC. And this merged entity, we call it a reverse merger because usually the merged entity ends up with the target company's name. So even if you start with a name called SPAC 1, ultimately you will end up with the target company's name. So because of this, we call this process a reverse merger, right? Because ultimately, in a usual merger, when you merge with your target, the target takes on your name, right? Because you're a big established company and you merge with the target, you acquire the target, and the target takes on your name, right? Because you're absorbing the target into you. But here, it's a share company. The SPAC is a share company. It's simply created to buy another company, right? It only has cash inside it. It has no business operations. Because of this, once the target and the SPAC merges, the remaining entity is the target itself. It is the target itself. So what have you done? You use the money to buy the target. And for the target, they've got now money. They merged with the company and they've got money through that merger process to expand their operations or whatever. So now you have this target company trading in the secondary market. Okay. So investors first give money to a blank check company. We call it a blank check or a blind pool company. Trust-like special purpose vehicle that has no other business. And suddenly they will find them, they know they are giving money for that purpose, right? And suddenly they will find themselves the owners of a different company. Because this blank check company will go and acquire target, and then investors will automatically become owners of that target company. So this is the reverse merger process, and now investors essentially will become owners of this target company, and they will be getting risk and reward of this target company. If the share price goes up because the target company does well, then the investors will be reaping the rewards of that, the benefits of that. If the target company pays dividends, the investors will get the dividends as well as the sponsor, right? So this is this process we call the de-SPAC process. The de-SPAC process, because the SPAC disappears, right? The SPAC disappears. So it's called the de-SPAC process. You de-SPAC it. So it's just like it is similar to you investing in a private equity firm. You don't have the expertise to go and find companies and give them money in terms of figuring out which are good companies, which are risky companies, I mean, the GP has more expertise, right? The GP can be wrong. Some of these companies can go bankrupt in a private space, but the GP will have more expertise in trying to identify which companies to give money to and which companies to not. And you, the investor, will not be will be de-risking yourself through that diversification process, because there are multiple investors who are going to be investing in this private equity investment. So it's not you that is going to own 100% of this company, right? So those similarities are there, even in a SPAC. I'll stop there for a minute for questions before I move for some other features.
During that period where SPACs were very famous, there was probably a lot of SPACs that raised money but didn't acquire companies. No?
Correct. So in a SPAC, there is a limited time when you get the money. When the sponsor takes the money, he can't keep this money forever, right? He has to deploy the money. So usually in the SPAC IPO prospectus, it will say within 18 months or within 24 months. That's a usual period that the prospectus will define, right? It's up to the SPAC sponsor to decide what the period will be. But within they promise to deploy the money to find a target within this set period of time, usually a max of 2 years, right? So within 18 to 24 months, that they're going to find a target and they're going to merge. And if they are not able to find a target and not able to merge, the money will come back to the investors. Okay. So this money, the sponsor cannot use for any other purpose other than to find a company and to merge with a company. If they do not fulfill that purpose, then the money will be returned back to the investors. So usually within a maximum of 2 years, you have to find a target company, merge with the target company, and return the money to the investors. So yes, during the period, like during COVID, you know that there was a lot of money in the system, right? Sri Lanka is not the only culprit of money printing. Everywhere around the world, there was money printing that was happening. Interest rates were going hit rock bottom because people were suffering, and you wanted to have a stimulative easing cycle where there was a lot of money transfer, cash transfers that happened to make sure that that people were not going through crisis periods, right? So in that sense, we are not alone in that. It's just that we had a worse economy that couldn't afford to do that versus some of the other economies, right? And the way that the cash transfers happened within us was different. But there was a lot of money that is out there, right? Which is why you see like there was these massive amounts of money actually created different phenomena. So for example, SPACs became very popular. That was one phenomena that was created. Bitcoin became very popular. Virtual currencies became very popular. Things like NFTs, non-fungible tokens, were introduced, and people started spending money on anything, right? But SPACs, in terms of SPACs, again, investors, there were a lot of investors that were coming to the stock market. Stock markets were performing really well. And one of these things that investors were doing was getting sponsors. So these were like really people that were had good names, big names behind them. Like, for example, the Chamak Palihapitiya you would have heard of, right? A big investor name, Sri Lankan heritage, who worked at Facebook for a while before, big investor name. He was big in SPACs. So he was a main sponsor in SPACs, where he took money in terms of trying to find target acquisition companies. His first few companies did well. As he went along, not so well. So SPACs had a boom and bust cycle where they really essentially there were a lot of people giving money to big names like Chamak Palihapitiya, saying, okay, I don't know where to invest. You find me a company to invest in. So the money would come into the SPAC, and then the sponsor would go and search around for a company and then invest in that company, because people like Chamak Palihapitiya had built up a reputation in terms of private equity where they had made investments which were successful, right? So this is where the investors, the retail investors, were saying, I'll give you money to find a company for me to invest in. But as we go along, a lot of the time, just like any boom and bust cycle, you see that less and less investors do less and less research and due diligence, and they want to get into the new SPAC. Things become overheated, overvalued, and less and less you will find that the targets were good. Targets were not good targets, right? So as you go along, as soon as the SPAC started, you had good returns, good targets. You became owners of good companies, so you could sell off your shares to somebody else at better prices. But as it went along, as usual, the same cycle continued where less and less targets became attractive. And there was a time where so much SPACs were being issued, or so many SPACs were there in the market searching for the same target or searching for targets. And, by the time you approach that 18 to 24 month window, right, whatever that window where you have to deploy the money, if you don't deploy the money, the sponsor has to return the money back to the investors. It's not in his best interest to return the money back to the investors. You have to understand that he also makes money once you acquire. So the SPAC, let's say, gets issued at $10. Usual issue price is something like $10, right? And that's because you tell investors, come and invest in this company. For every share that you get, you pay $10 and you get one share, right? But how does the SPAC, how does the price go above $10? Because of the value of this target company that you acquire, right? So once you acquire the target company is supposed to create that value so that it goes to the 20, 30, 40, whatever levels. And therefore, you can exit the company, sell the company at higher prices, profits. So most of the time, what happens is if you don't find the right target by the time you approach this deadline, sometimes sponsors get incentivized to merge with any target, which might not be in the best interest of the investors, which is a lot of the time, which started to happen towards the tail end of this SPAC boom. So that was one problem that happened. And also, in a SPAC, unlike in private equity, in a SPAC, investors have a little bit more say. It's not that they can decide the target, or they can say, I don't like you merging with this target, don't merge with this target, because they are still minority investors, right? Small investors. But if they don't like the target, they can walk away from their investment. SPACs give investors the option to walk away, meaning to take their money and go. So the sponsor, when he identifies the target, he has to present the target to the investors. And if the investors don't like the target, not every investors who like the target can keep themselves or maintain themselves inside the SPAC. They remain as shareholders, right? If you don't like the target, you essentially say, I don't like the target, give me my money back, and these investors walk away. So that is an advantage that is given to retail investors to make sure that they are not taken for a ride, or they are not taken advantage of, right? So a lot more you started seeing that in SPACs, more and more people stopped the investment or took their money out and walked away. And that means you don't now have enough money to acquire the target. So in this SPAC bubble or SPAC cycle that we saw, you will see the number of SPACs increase, right? So like 2021 saw the highest number of SPACs being issued in the market. And then the popularity of SPACs have now pretty much died down. It's not that SPACs were not there before, but the popularity of SPACs became very high during COVID. And investors now, what you start to see is you have less and less SPACs being issued in the market because the popularity of SPACs have died down. It's more difficult to convince investors to come and invest in a SPAC, right? But it was a good method if, again, the problem that happens is with any, when the market goes up, you see a lot in Sri Lanka, people start to take advantage of these cycles, and there's a lot of pump and dump, and even without pump and dump, exuberance that is there, that kind of heightens prices without any rationale, right? And then you have these overvaluations that happen, and stock prices have to readjust, and people lose money. Same thing, same cycles happen with everything. So this is in the SPAC cycle also, you saw that people were making good money. Investors started to pile on without doing their due diligence. And what happens in the next SPAC that's issued, and the next SPAC that's issued, and the next SPAC that's issued? The sponsor makes more money than the investors, and then investors lose interest, and then the investors stop coming, and SPAC cycle, the SPAC bubble bursts. So that is where we are right now. Questions? So technically, the sponsor actually doesn't have the same share, right? The way that the SPAC gets structured sometimes is that the sponsor puts less amount of shares because he first has the SPAC with him, no? So he puts a lower amount of money and has a higher amount of shares. And then he floats the company at $10 a share and asks investors to invest in it. So there is the amount of money that he put to purchase a share at the beginning before the SPAC is floated is lower than what the investors will put. So the sponsor's contribution generally to the percentage of shares that he owns will be lower. His cost will be lower. It is, but see, the sponsor, the rationale is, right? And why that happens, it's not that the sponsor is trying to play you out, but the sponsor is the sponsor. He's doing a job, right? So for that job, that's his compensation, that he gets the share at a discounted price. Because he's there, he's doing the evaluation, he's getting his analysts to evaluate what companies to buy, right? So because of that, he gets the share at a discounted price. For him, not be as, yes, exactly.
When you said that some of the investors exit.
Can walk away. Yeah.
How does it work? They just sell the SPAC share in the market and exit.
Not to the market, you sell it back to the sponsor. So the SPAC has to buy it back. So this money is held in escrow, right? When you give the money to the sponsor, see, investors' funds are placed in escrow. So the money can't be utilized for anything else other than acquiring that merged entity. So if you raise, let's say, ₹1 billion to find a company to merge with, this money can't be utilized until you merge. So at the time of the merger, you hold an EGM or whatever, and you tell the investors, this is my target company. This is what you're going to become owners of. And if the investors don't like the target, they will say, give me back my money. So they will essentially sell the shares to the SPAC. SPAC will buy back the shares and give them back their money. And the buyback prices and all that, what price, all that will be highlighted in the SPAC prospectus. So the SPAC will also have a trustee because it is a special purpose vehicle. That the trustee is the one that will hold his money essentially in to make sure that the sponsor doesn't utilize the money, and the trustee will be there on behalf of the investors to make sure that the money is there and being invested in very like short-term instruments, right? And in 2020, 2021, imagine you're not even earning money, unlike this overnight repos or overnight repos or 7-day repos or treasury bills or whatever, right? So they're invested in very short-term instruments because you're keeping them liquid to be utilized anytime. It's not that this money is being invested, but it is just earning a return just for the sake of earning a return, right? So they earn small amount of interest while waiting for the merger. So one thing I forgot to say was another reason why SPACs also are popular versus just why. Why not this target company who is now becoming a public company, right? This target company is a private company who, because of this reverse merger process, becomes a public company. Why not this target company itself just go and ask for money from investors? So a lot of the time, again, these target companies would probably be companies that will find it more difficult to come to investors and ask for money because investors simply don't understand uh, the type of industry they're in. Let me just show you something 1 second. This is actually one of your past papers, right? 2 years ago, past paper. So I hope you can see it. So this is on a SPAC, right? The case study was on a SPAC. So this is one of Shamath Palihapitiya's SPACs called Social Capital because that's his essentially his company is Social Capital. Social Capital Head Sophia Holdings announces closing of IPO, right? So IPOA, it's a blank check company formed for the purpose of entering into a merger, share exchange, or asset acquisition. Today announced that the initial public offering of 60 million units at a price of $10 per unit. So they raised $600 million to acquire another company. Okay. The units will be traded in the New York Stock Exchange under IPOAU, right? Not U because it's units. And usually in a SPAC, you will be given not just shares, but a warrant as well, right? So you have shares and you have a warrant. In this case, for every share that you purchase, you get 1/3 of a warrant. So for every 3 shares, you get 1 warrant assigned to you. Okay. And if the initial business combination is the de-SPAC, the reverse merger process, right? You can read through the terms, but here, the IPO proceeds will be deposited in a trust account with JP Morgan Chase. So the trustee is JP Morgan Chase. Account at JP Morgan Chase with Continental Stock Transfer and Trust Company acting as the trustee. Okay, and the trust can only invest in US government treasury bills or in mutual funds solely invested in short-term US treasury bills. Okay. And if the initial business combination, here it defines what the initial business combination is the acquisition of the other company, right? The reverse merger process. So if the initial business combination is not completed within 24 months, so you have 2 years to find another company to merge with, then the proceeds of the trust account will be distributed to the public shareholders. And if the public shareholders disagree with the proposed reverse merger, they have the option to redeem their shares in exchange for cash at a price per share equal to the amount accumulated in the trust account, including interest divided. So it's essentially the price that they paid plus the interest that is accumulated inside the trust. Yeah. So Virgin Galactic is set to trade in the New York Stock Exchange on Monday as the first space tourism stock. So it's the first space tourism company, right? So Virgin Galactic, Sir Richard Branson's Virgin Galactic was essentially the company that was acquired through this SPAC. So in 2019, this SPAC was done in 2017, and just closer to that 2-year period in 2019, you can see that the SPAC went and acquired or merged with Virgin Galactic, right? Not the original Virgin Galactic, the company. This is actually their space tourism company. So this is the company that promises to take people, your high net worths, to space, right? Because still people like us can't afford this type of space travel. But this is where you can do space travel, space tourism. So private space tourism is about to go public according to SEC filings. Shareholders approved the Virgin Galactic merger in one of Chamath Palihapitiya's SPACs, right? So IPOA. And VG will become the first human spaceflight company to trade on the public markets. And the thing is, this is the ideal type of investment for SPAC and for VG, right? A company like VG, space tourism company, right? It's not there in the market before. How do you value a space tourism company? Can you come to the investors? Now, they want money to build up their, space shuttles to go to space to see the Earth from space, right? They need money. They are a company that's cash hungry. But can they come to investors with an IPO? Investors will be scared to invest in a company like this, right? Because it's too risky. You don't know whether it will fail or succeed or what. It's an ideal company for either private equity or if they want to approach public equity, probably they will not be successful through an IPO. But now, because of SPACs, they are actually a traded company in the market because somebody with more sophisticated knowledge, right, a more sophisticated investor has, like, that's a private equity company, right? But now it's not a private equity company, it's a SPAC, a public equity analyst who has analyzed this company and figured out, okay, they want to give money for this company. You and me, if this company approached us and if the investment bank came up with this company, might not want to invest because of the sheer riskiness of it. But because somebody else is doing, and somebody of reputation is doing that analysis and saying, we think this company, we've done the analysis on this company and we think this company is going to do well, or has good plans in terms of, and we think the plans can work, whatever. And they will do that pitch for you and say, so we are going to acquire this company. And then the investors can decide whether they want to keep their money with them, within the SPAC, and do that de-SPAC process, or take it out. Okay. Yeah. So here you see the merger first announced in July with social capital head of Sophia IPOA taking 49% stake in Virgin Galactic, right? So that 600 million represents 49% stake in Virgin Galactic, gives the combined entity a valuation of 1.5 billion, right? And Sir Richard Branson, who is the founder of Virgin Galactic, will retain that 51% controlling stake. So the SPAC, Palipati SPAC already trades in the New York Stock Exchange under IPOA. Merging with Virgin Galactic is expected to close by Friday, and after merging, the shares will trade in the New York Stock Exchange from Monday. Merge on Friday, and from Monday onwards, the shares will trade under the new ticker symbol SPACE, SPCE, SPACE, right? Because it's space travel. Replacing the ticker IPOA. So the SPAC will cease to exist, and it will be a new company, Virgin Galactic, that will become the SPAC. By buying, so yeah. And this is in terms of the valuation. Virgin's spacecraft can carry 6 passengers and 2 pilots to nature space. Ticket is about $250,000 per person, and they have 603 customers in the waiting list, with 80 million in total collected in deposits from the 603 customers. So kind of gives you an idea in terms of SPACs, or in terms of like how a SPAC would work, right? So here, do you understand the statement where it says an IPO is basically a company looking for money? A SPAC is money looking for a company. What does that mean? Oops. Investing. Yeah. So any other questions on SPACs? It is and it is not. It is a sweetener to the extent that you can trade the warrant separately, right? So you have the SPAC and you have the warrant. So you have, for the money of your $10, you get the SPAC shares, the SPAC units, plus you get, for every 3 shares in that example, 1 warrant. So the warrant can be traded separately. So the warrant is, remember, the ability to buy a share of the SPAC at a discounted, hopefully discounted price at a later date, right? So you know a set price is there, and on a later date, you can buy more shares of the SPAC. So if you feel like this SPAC, for example, the company that you're going to, within that 2 years, the company that you're going to acquire is an attractive company, you can decide to buy more shares of the SPAC by utilizing that warrant. So yes, it is a kind of sweetener that is given to shareholders. And if they want to, they can recover part of their costs by selling that warrant as well. As well as, sorry, and one more thing, as well as for the fact that when you have a warrant, it's the ability of the SPAC to raise more money, right? The warrant gives the SPAC the ability on a later date to raise more money, because it is a prolonged rights issue. Remember what a warrant was? It is not a rights issue that is happening immediately. It's a predefined, pre-specified rights issue that gives the ability for the company to raise more money at a later point in time. So there is, that within the next 2 years, at this point in time, the SPAC is going to ask for more money from you, which you can decide whether you want to give or not, depending on whether you are interested in putting that money into the SPAC or not, exercise the warrant or not, because the warrant is a call option. Okay, no further questions? No. So we don't have the rules for SPACs yet. SEC and Stock Exchange have evaluated it, but at the moment, I don't think they've come up with it as a feasible product. So with SPACs, one advantage with SPACs and why sometimes the other type of reasoning for places like Virgin Galactic to go with SPACs, right, is the fact that you can, SPACs don't have anything. It's blank check. There is nothing inside it to evaluate. So really, you can collect money from investors and you can come and do an IPO. Now, generally, when you do an IPO, you know that if you want to get into the main board, you have to have minimum 500 million stated capital, and then you have to have 2 years of profit. Your net assets have to be positive, right? And if you want to get into the secondary board or there is a board, or like you want to do an Empower board or something, there are certain restrictions that are there in terms of your profitabilities and so on. SPACs don't have any of that. So SPACs in that sense have less paperwork, less approval processes. It's easier to list. But once you list, then you go and merge with another company. So again, it's easier for that second company to be listed on the exchange as well, because the exchange does require some information when you're merging with the company, but it doesn't require as much information as if the company came and, let's say, a company like Virgin Galactic, which doesn't have profits at this moment in time, which is, just setting up, they would find it very difficult to come and do an IPO, right? In terms of the documentation required, in terms of the minimums that are required, all of that. So the SPAC helps in that way. But if you look at Sri Lanka, probably there's something that the SEC or CSE doesn't want to get into yet, because how do you regulate the sponsor? How do you make sure that, there are problems in terms of once you get that money, where do you utilize that money for, no matter what? In terms of our financial literacy, there is a higher burden on the SEC and the CSC in terms of the newer products that are issued. So probably the reason why we haven't seen the rules come out yet. Do you remember the name? I don't remember that. Was it like a local company or a foreign company? But that is more private, right? That is not a exchange listed company. So it doesn't go under the SPAC territory, more under the private equity territory. Sure. Yeah, sure. Okay. I don't remember that, but I would say to that probably because we don't have that accredited investor limitation so much in terms of the private equity that is being floated at the moment. So since the new 2021 SEC Act, now there are some restrictions in terms of how you would do your private equity transactions, right? The type of funds that you would raise and the type of investors that you can have, and you have to be registered and all that. Still, it's not really properly in force. So because of that, there is technically no restriction in terms of advertising to retail investors to collect money and to do a fund and collect money and do this. That's probably what has happened. Versus in the US, there are defined. I mean, you have restrictions on the number of investors, type of investors, if you're doing a private fund. But do you remember the name? I just want to look it up.
Was it Supreme Global Holdings?
Let's look at it during the break. I'll just take a look. Thanks. Okay. Other questions? I'll look through it because I can't honestly remember that. Right. So we come to Bitcoin or cryptocurrency. Yeah. The final type of investment that we will talk about, alternative investment that we will talk about. So, in terms of cryptocurrency, these are essentially digital money, right? Essentially money that we use for doing transactions in a virtual space, right? And cryptocurrency again has gained a lot of traction especially since 2008, 2009, with the advent of Bitcoin, right? With Bitcoin being launched in 2008. And this has since then gained a lot of traction. And why did Bitcoin come into play? A lot of this again happened with the global financial crisis and people losing trust in the system, right? Again, in the global financial crisis, we saw so many businesses, especially in the US, which was in the middle of it, right? So many businesses, so many people losing money, losing jobs, losing their, income streams, revenues, right? But there was a lot of anger within people towards investment banks and towards banks in general, where they were being paid very high bonuses, despite the fact that these were the institutions that were doing a lot of these securitizations, a lot of these, MBOs, mortgage-backed obligations and MBSs and all that were going bankrupt, and therefore people were losing their investments and invested money, right? With this whole disillusionment that happened in the system, you had a lot of people moving towards decentralization, where they said they don't want governments or a central body deciding what is right and what is wrong and what is money that should be used, or verifying how the money transacted, and which is where you saw currencies like Bitcoin become very popular. Actually, it's not that these virtual currencies have not existed before Bitcoin, right? So you do have virtual currencies that have been there before Bitcoin. But Bitcoin obviously is considered kind of like the mother of these virtual currencies now, because this is one of the most popular type of virtual currencies that you have, and that has really changed the market outlook and the market space in this area. So in terms of Bitcoin and in terms of the types of transactions that you can do, right? As well as, sorry, what's it? So 2008 was when Bitcoin was launched. It was launched by, there was a paper that was done by a person or group of people called Satoshi Nakamoto, right? They still don't know exactly. There is speculation in terms of who Satoshi Nakamoto is, but technically nobody exactly knows who Satoshi Nakamoto is. And where they came up with this whole structure of peer-to-peer transactions and peer-to-peer networks, right? Where you, without the control of a government or without the control of a central authority, without the control of a central authority, you manage the transactions through the verification of a peer-to-peer network through open source software. So this peer-to-peer network is what we call blockchain. And again, blockchain is not invented by Satoshi Nakamoto or Bitcoin. Blockchain was actually invented much earlier, actually 1982, right? In 1982, by a person called David Chaum. Again, there were similar concepts to blockchain, but he is essentially kind of what is known as the modern father of blockchain. In his dissertation from the University of California on computer systems trusted by mutually suspicious groups. What are you saying? You get decentralized groups of people to verify transactions, and you maintain these transactions in a central ledger, right? Sorry, not a central ledger, in a ledger that is replicated across multiple different people. So every time a transaction happens in a blockchain, what will happen is you will record the transaction and you will record it in what we call a block, right? And within that block, so let me start off by saying I'm not very used to this area. So correct me if there is anything wrong as we go along as well. But once you record your transaction, right? So the transaction will record from who this transaction originated from, the person from Y, to whoever this transaction is going to, the amount of the transaction, right? This whole set of data gets recorded in a block. And this block gets recorded into a chain of other blocks before it, right? So when Satoshi Nakamoto, right, when they did the first transaction, what they call the Genesis block, the very first block that was released, that recorded the very first transaction that happened in Bitcoin. So whereas this first Bitcoin was transferred from, I believe it was Satoshi Nakamoto's account to, I think, Hal Finney's account, again, another person who is suspected to be Satoshi Nakamoto, right? One of the Bitcoin, so one of the people who are very much involved in this whole process. That very first transaction is what we call the Genesis block. So imagine in this Genesis block, the very first block, you have the first transaction of Bitcoin recorded that essentially said, let's say, I can't remember exactly, Satoshi Nakamoto transfers to Hal Finney 50 Bitcoins, right? 50 Bitcoins. And this is the very first block. And this block would have a unique identifier or a unique identification number. And then once the second transaction happens, right, in the second transaction that would be recorded in the next block, it would have what happened to the Bitcoin from this person to the next person, right? As well as, how much Bitcoins, whatever that got transferred from this person to this person, as well as the code from the previous block. So the code from this block, whatever the identifier of this block, part of that code would also be on this block. Now from 2008, imagine the number of transactions that have been there. For each of these blockchain transactions, there is a block recorded. Generally, a block gets recorded every 10 minutes. A transaction gets recorded every 10 minutes, right? So imagine the number of blocks that are created, and every block is interlinked to the previous block. Okay. Which is why we say that in blockchain, it becomes very difficult to change or hack the blockchain or hack these transactions, because once you hack it and you say you want to change a transaction and you want to erase a transaction or you want to change it to your name, whatever you do in this block, you have to keep changing it in the previous block. And then that block is related to the previous block. So you have to keep changing that. So say, for example, you want to take all this guy's money and convert it to your name. You want to change it and you want to convert it to your name. You're hacking the account. To do that, to suddenly have your name as the owner of all of this money, you have to keep on changing all these blocks right back. And that is a near impossible task, right? Because it might be not just, say, this is not the Genesis block in the second transaction, but it might be a transaction that occurred 1 year ago. But before that 1 year, that money was held by somebody else, and by somebody else, and by somebody else. So you have to keep on changing that set of figures to be able to do this. And before the next block, gets implemented, which will again change the transaction data, and this block can't be changed then, right? So because of that, and the next block, generally, we say every 10 minutes, you will see you will be able to create the next block, right? Roughly. So blockchain becomes a way of recording transactions in a very secure manner, in a way that is, we say generally, unhackable. Okay. So there is what we call a 50% rule, because all of these blocks are verified by decentralized users across the world. Right? We call these users nodes, right? Network nodes. So decentralized computers across the world would have started with a few computers, a few nodes, a few people who are transacting in Bitcoin. Now, after realizing how valuable Bitcoin is, or not just Bitcoin, this is for any cryptocurrency. Each crypto type of currency will have their different blockchains for each of these crypto currencies. You have multiple nodes that are verifying each of these transactions, right? So because these multiple nodes all have the same ledger, you have to keep not just change this one ledger that will have the fact that, you started with 50 Bitcoins and now you have added, deducted over the number of years, and now you have 500 Bitcoins. And now this person wants to hack it and change that number to 1,500 Bitcoins. That verification, when you want to hack it and change that number to 1,500 Bitcoins, you have to keep on changing this ledger back, right? And whoever held the Bitcoins before you, also you need to keep on changing. So this becomes a near impossible task, especially because of the verification that is happening across the board with multiple number of other decentralized computer holders, or essentially nodes. We call them nodes in the system. So within this, so anytime a transaction happens, it gets transmitted to the network. So if you want to send money to somebody else, it gets transmitted to the network that you are sending money to the other person. Okay. And the network validates this transaction, right? So this is something that happens in Bitcoin for different types of currency. Like, for example, the top 4 currencies that have been identified right now for 2024 by Forbes is Ethereum, Tether, and Binance coins, right? That's the top 10 right now. So you have Litecoins, you have USDTs, Tether, but you have different types of cryptocurrencies, more than 4,000 types of cryptocurrencies that are out there. But these are the most popular, and Bitcoin still remains the most popular cryptocurrency that is really used for trading, transactions, and all that. I mean, every time we hear about Bitcoin, about cryptocurrency and the prices of cryptocurrency, we talk about Bitcoin, right? So the nodes, what they will do is they will validate this process. So in a Bitcoin transaction, they will validate the data that comes out in terms of X wanted to transfer a certain amount of Bitcoins to Y. They will validate, okay, X has this amount of Bitcoins and this Bitcoins will go and transfer to Y. And this transaction will be added, this transaction data will be added to the network, right? To the blockchain. Sorry, to the blockchain, not the network, to the blockchain. How does this transaction data get added to the blockchain? All the transaction data is written in a code, and then the code is essentially, there's a certain amount of mathematical equation that is carried out, and the first person, we call these people miners, right? Who will carry out this writing of the block. And in the writing of the block, and they will write the block, as well as they will when creating that block, there will be a mathematical equation that they will have to solve. So there's a certain amount of computer power that is required for that. And the first person to solve it, or the first miner to solve it, essentially gets rewarded with Bitcoins. So how the program was written is, there are overall 21 million Bitcoins that you can technically, we say, mine. Meaning, these are not Bitcoins, these are not out there. Think of it like gold. right? That's why you call it mining. This is like the coins will be, how would you say, extracted from, you can think of it, right? I'm not saying the right thing, but you can think of it like there is a place where the coins are, the mines, right? And from that mine, you can extract the coins by doing this complicated code. And the first person to solve the complicated code um, will be rewarded with certain amount of coins. You can extract the coins. So how do you extract the coins? For every, initially, as soon as in 2008, as soon as they did this program, you were able to extract 50 coins. So 50 coins were given as a reward to the people who were doing the code. So that was how these nodes came into being and the miners came into being. So it was kind of where you were trying to extract the coins, right? And anybody who solved the code first, you get rewarded with the coins. So you start with 50 coins. And for the next code that you are able to solve first, you get rewarded another 50 coins. Like this, you keep on getting rewarded 50 coins. But until you reach 21 million. But if you reach 21, with 50 coins being mined roughly every 10 minutes, you can reach 21 million pretty fast, right? Now, what they did was, what Satoshi Nakamoto, whoever that is, did was to create scarcity in the system, to create a system where you would make sure that always there is some amount of demand for the Bitcoins. What they said was, of this total 21 million Bitcoins that are there that can be mined, there is a halving of the reward, right? Where the amount of coins, the amount of the reward that you get halves for every 10% that you mine. Like for every 210,000 coins that are mined, 210,000 coins that are mined, your reward halves. So after the 210,000th coin that is mined, the next set of coins that get mined only gets a reward of 25 Bitcoins. The next 210,000, so after 420,000 coins are mined, the next set of coins only get 12.5 Bitcoins as a reward. This halving generally happens when you look at the timeline, roughly every 4 years, right? So 2012, there's been a halving. 2016, there's been a halving. 2020, there was a halving. And very recently, in April 2024, there was a halving. And now the reward that you get for mining Bitcoins is 3.125. And at this point in time, roughly 19 million odd Bitcoins have already been mined. And they estimate, according to calculations that have been done, that it will be about 2,100 by the time you are able to mine all of these 21 million Bitcoins. What does it do when you keep on reducing the reward and keep on reducing the number of Bitcoins that come into circulation? It kind of creates an inflation in the system, right? Because it creates scarcity. So because of that, Bitcoin prices, which is part of the reason, obviously there is other demand supply reasons, but another reason why Bitcoin prices keep going up is with increased usage combined with increased scarcity of the product will mean that prices can move up. So Bitcoin has been a really in a big way. You can see that how Bitcoin prices have moved, right? So now Bitcoin is trading somewhere around 66,000. 66,000. Started at less than like 2 cents and now 66,000. Bigger problem with virtual currency is that virtual currency is extremely volatile. You will have some of these currencies might be less volatile than Bitcoin, but still extremely volatile. So because of that, can they be used as a mode of exchange? Not necessarily, right? Actually, people do use it as a mode of exchange, and there will be some format that it might come as a mode of exchange. But whether right now the coins that are out there, whether these coins in this format can be used as a proper mode of exchange or a continuous, consistent mode of exchange, will have to be seen, right? But definitely, there are people that accept Bitcoins as a way of payment. I'm not just talking about exchange and trading on Bitcoins. I'm talking about actually buying goods using Bitcoin. Okay. So there were times actually apparently, so smaller companies, definitely there are certain companies that will accept Bitcoin as a mode of exchange, right? And if you look at, for example, the way Bitcoin, this is part of the reason why companies accept Bitcoin as a mode of exchange. The high volatility means if they buy Bitcoin at certain points in time, they can make much more massive profits by holding on to it when prices change. But you can see how erratic the prices are, right? Jumping from like in 2022, do you see the fall, the size of the fall? You're here, 60,000 levels to 15,000 levels. The size of the fall is magnificent, right? I mean, these are not the types of falls or radicals that you will see in stock markets even. So the volatility of these types of investments are very high. But that also creates opportunities, obviously, for people. But does it then become a stable medium of being able to use as a medium of buying goods and services? That's the question. Certainly, there are institutions that use this. You can transfer Bitcoin instead of transferring fiat money to buy certain goods, like, for example, coffee shops. Certain coffee shops in certain jurisdictions in Europe, in the US, will accept Bitcoin as a mode of transfer, right, as a mode of payment. There was apparently Microsoft, Tesla, Walmart, they used to accept Bitcoin. Apparently, they don't anymore. And part of the reason that they don't anymore is not because they don't believe in Bitcoin, but because of the environmental harm that Bitcoins cause. Because there is a lot of criticism around the fact that the amount of computer usage that is required for this proof, we call this proof of work, right? To solve these mathematical equations, the amount of emissions, the amount of heat that is related to the atmosphere is so high to get a very small reward that these companies have now moved towards saying that they're not accepting Bitcoin as a mode of exchange because there is too much harm done towards the environment. So certainly, I'm not talking about all companies, but these particular companies specifically have essentially said that they will stop accepting Bitcoins as a mode of payment because of that. Any questions?
One question now. What does the real value attach to Bitcoin? Because any currency in the globally that reflects the country's wealth, at least to a certain level. But what is the wealth behind Bitcoins?
So, good question. When you talk about a country, what you say is, well, the country started with, actually, when you look at countries, a lot of the time these notes or these coins started with being attached to a certain value of, let's say, for example, metal, right? Now, if you look at, for example, trading, the the 1 pound coin. Okay. The 1 pound coin, those days, used to be 1 pound of silver. That's why it was called a 1 pound coin. Later on, that 1 pound of silver cost too much, and therefore it became essentially a transferable coin. with the government coming in and saying essentially that there is an IOU where we will undertake to pay you £1, not £1 of silver, £1 for your coins, right? So yes, the coins, whatever the coins or your notes or whatever, do reflect a certain amount of underlying economy. With Bitcoins, again, it is an underlying economy. It is a more global economy, right? So it's not necessarily that you don't have anything underlying that is with that transaction, but so many things happening with Bitcoin that it becomes very difficult to justify it into one category or one single thing. Like I said, scarcity of having that 21 million coins is one thing that will impact demand and supply. Um, there are so many other global factors that impact demand and supply. You know, how much money is there in the market, how much trading that happens in the coin. So yes, it becomes a little bit more difficult. Bitcoin, though, did come out as another safe haven asset during COVID. So during COVID, what you saw was Bitcoin prices went up a lot. And you see that in the previous graph as well, right? So during COVID, actually Bitcoin prices surged because it was a way for people to utilize that money, actual money. What they did was they transferred it to virtual currencies. So the demand for virtual currencies went up. And just like gold went up during COVID times, you saw that Bitcoin also had some sort of safe haven element where people were scared that the fiat money was losing not credibility, but losing strength, right? During COVID, with countries doing so poorly, what they did was they started to hoard it towards virtual currency. So Bitcoin kind of came out as a safe haven asset during that time. Of how we want to do the transaction, right? Storing your wealth, yes. No, thank you. So yeah, so that's a good explanation in terms of other types of coins. And then you have stable coins, which stable coins are basically, you will see that they are much more stable than these than Bitcoin, for example, because these stable coins are attached to, I hope you can hear me. It says network connection unstable. Stable coins are attached to some underlying asset like the US dollar, right? So those are other examples. But yeah, thank you. So in terms of coins like Ripple, apparently it's you're attached to certain utilities, right? Okay. Any other comments or questions?
Madam, small question that when people buy bitcoins, where those funds are deposited and who have the possession of those funds?
So it's essentially a virtual currency, right? It is technically not deposited anywhere, but the ownership is transferred to the fact that it says you are now the owner of this coin, and you are. There is nothing physical there. for you to see that there is funds deposited, and only a ledger that says, okay, you are now the owner of this amount, and somebody else is the owner of this amount, right? But when you do a transaction, you have what is called a wallet. In that wallet, essentially, you will create a code. What we call within a wallet, you will create a digital wallet. You will create a code that will say, it will give you what we call a public key and a private key. So the public key is what you transmit to the other person, and you tell them, okay, so if you want to send money, this person has to send you his public key and say, okay, send money to this address, right? To this point. And you can then, through your signing in through your, you can send money to him, and he can access the money by signing through his private key. So that private key belongs to you only. It's something that if you lose, you cannot identify, you cannot find your money. If you don't have the private key, that money is gone. Okay. So that's a lot of the time we say, so you have what we call hot wallets and cold wallets. So hot wallets are essentially anything that is connectable to the internet. Cold wallets are what you keep outside of the internet, right? Outside of any web connection. So in a hot wallet, like if you have your wallet, your virtual wallet in a phone or in your desktop or whatever, that is anything that's easily connectable to the net, we generally say that that's not a good thing, because it can be hacked, right? It can be compromised. Versus cold wallets are like USB drives. You can keep it outside and only connect it when you want to connect it. And when you have hot wallets, sometimes the problem is, if you get hacked, right, your keystrokes, what you type, or your screen might be visible to the hacker, in which case your Bitcoin can be stolen because the private key will be visible. Versus, which is why they advocate go for cold wallets. And again, if you store your Bitcoins in an exchange, right? You are, like, for example, you're trading on Bitcoins and your wallet is with the exchange. That essentially means the exchange has the private key. You don't have the private key. So if the exchange gets hacked, you lose all your money. You can lose all your money. So the very first time this happened, there was an exchange called Mt. Gox. The Bitcoin they got hacked. A lot of people had stored the money in the exchange. And again, when we say stored the money in an exchange, it's not that the money is there. The money is in the ledger, recorded in the blockchain. The problem is, once the hackers had access to the private key, they will transfer from the ledger to whatever the other location, right? So the ledger will then say there is a transaction that has happened, and the money gets transferred from this wallet to another wallet. So the private key you don't have control of when you hold the money through an exchange. Okay, the money is still in the ledger, but you don't have access to the safety of the money because the private key is with somebody else. And with Bitcoin, what happens is, although the public key is visible, the person who owns the public key is not visible, right? So you can identify through the ledger that the money has been transferred, let's say from Mt. Gox exchange, to this person with this public key. But who is that person holding that public key? You can't find out. I mean, it's a 16-digit code, right? The public key is a 12-digit or 16-digit code. You will not be, you would have to know specifically who is the person who holds that public key to be able to figure out who stole your money. Yeah. So let me show you a couple of videos again, a little lower. So the information when they say the amount of money that you get for mining, they might be saying 12.5 or 6.125 because the videos are slightly older, right? Right now, the amount of money that you get for your rewards are 3.125 since April this year. And right now, about 19 million Bitcoins, 19 plus million Bitcoins have been mined already. But the videos are kind of a really nice explanation in terms of the history of Bitcoin. And the first video is a very short video about Bitcoin. So let me just quickly show that and then take a little further questions. Sorry, this. Okay, thank you. Let me check that. One second. If you don't hear the sound, let me know.
We can't hear the sound.
Thanks.
You may have heard of Bitcoin by now, and the hype it had over the last few weeks, reaching all-time highs, then boom, dropping over $1,000 within minutes, and a few days later, hitting a new all-time high. 7 years ago, 10,000 Bitcoins were used to buy 2 pizzas.
Now $60,000.
One is worth over $10,000. But what is Bitcoin really? Basically, it's a new form of currency known as cryptocurrency, or crypto for short. It's not like everyday paper money that we're used to, but a form of digital currency invented by a mysterious person known as Satoshi Nakamoto. The goal was to create a peer-to-peer system for online payments. P2P means that it's decentralized and works independent of any financial institution. Think of it like this. When you go into a coffee shop to buy a latte with your bank card, you don't actually give any money to the cafe owner. The bank does. With digital currency, there's no banks, no entities, or governments that control it, eliminating the need for a middleman. So where does Bitcoin come from? Well, it's mined. Not with a traditional pickaxe, but with computing complex mathematical equations. Once the equations are solved, new Bitcoins are generated, or mined. The term mining is commonly used because, like our mineral resources, there's a limited number of Bitcoins out there. In the case of Bitcoin, that number is 21 million, period. But there's more. Miners don't only generate new Bitcoins. They use their computers to verify transactions and prevent fraud 24 hours a day. This is done by collecting all transactions made during a set period into a list, called a block. It's the miner's job to confirm those transactions and write them into a general ledger, which kind of resembles a huge, giant, universally accessible spreadsheet. So instead of one person controlling everything, there are thousands of computers around the world connected to a network which all come to an agreement on which transactions are valid. But how does it do all this? By using something called blockchain. If Bitcoin is email, then blockchain is the internet. It's a whole ecosystem that we'll cover in another video. Another thing to mention, mining Bitcoin is costly. There's the high cost of electricity and the hardware components wearing out. An individual mining Bitcoin would find it really difficult to make any money that way. That's why there are Bitcoin farms around the world, mining, processing, and verifying transactions. People can invest in them and get a small percentage of the returns. Alternatively, Bitcoin can be traded on many exchanges. An exchange is a marketplace where you may buy or sell your crypto in exchange for regular currencies. There are many exchanges that any person can use. Coinbase, Bittrex, and Kraken are some of the most popular.
One more. So this kind of tells you the history of Bitcoin.
Video, we'll talk about the coin that started it all. The king of crypto, the coin that to many people is synonymous to cryptocurrencies. Bitcoin. 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 So, without much ado, let's dive into our brief history of Bitcoin. It all started soon after the financial crisis of 2008, when on October 31st, the now famous white paper, Bitcoin, a peer-to-peer electronic cash system, was shared on a cryptography forum by Satoshi Nakamoto as an answer to the shortcomings of the traditional fractional financial system that had led to the crisis. The problem with electronic payments in the past is the risk of the same money being spent twice. This is called double spending. The issue was the inability to verify whether a digital currency has been spent more than once. The only solution that existed up to that point was to have a trusted third-party entity that verified all transactions, like a central bank. But the experience of 2008 had shown that these trusted entities don't always work in the best interest of the people whose money they handled. Satoshi solved the double spending problem by using cryptography, proof of work, and a decentralized peer-to-peer network of nodes that validate transactions and transfer the ownership of wealth to each person's hands. What a brilliant idea. What Satoshi proposed was that transactions would be added to blocks of data, each with a timestamp of creation, and each new block would be added after the previous one and would be cryptographically related to it, so that if one block is changed, all subsequent blocks must be changed too. And thus, the blockchain was created. But in order to create a new block, there needs to be a cost to it. Otherwise, anyone could add any number of arbitrary blocks to the chain. That cost is none other than the electricity needed by computers to solve a mathematical problem. The first one to do gets to add a new block to the chain. This new block generates new bitcoins, which the miner that solved the problem gains as a reward for their efforts, along with all the transaction fees. That is proof of work, also known as mining, referencing the effort needed to mine precious metals. This proof of work also secures the network because in order for an attacker to take control of the network and change previous transactions, they would need to control the majority of the computing power of the network, the infamous 51% attack. As we know, the cost of running a miner today that actually mines bitcoins is extremely high, making the accumulation of such power by one single entity practically impossible. But even if 2 or 3 mining pools join forces and acquire the necessary 51%, it would still not make financial sense to attack the network.
So you can see here, these are like the different mining companies that are there. These numbers would have changed around a bit, but you can see the different types of. So what he's saying is, for all of these different mining companies, you have to be able to hack into like more than 51% to be able to change the ledgers. Right? Otherwise, you can't change the transactions, and it won't be in line in terms of it will be identified that the ledgers are not, so somebody has hacked into it.
As they would completely undermine their own wealth by destroying the credibility of Bitcoin. All that and more were described in the original white paper that started the amazing journey of cryptocurrencies. A few days later, Nakamoto registers the product on SourceForge, the open source code platform, and on January 3rd, 2009, the first ever Bitcoin block, named the Genesis block, is mined, awarding Satoshi the first 50 Bitcoins of the 21 million that will ever be created. In that block, Nakamoto puts the message, "The Times, 3rd January 2009, Chancellor on brink of second bailout for banks." A headline of London Times that day, which has been interpreted as both a timestamp and a critique on the traditional financial system. On January 9, version 0.1 of Bitcoin is published. It's so complete that for many, it's an indication, along with the ingenious ideas inside the white paper, that Satoshi Nakamoto cannot be just one person, but it is the pseudonym of a group of people. The identity of Bitcoin's founder remains a mystery until today. And although many names have been proposed, there has been no concrete proof for any of them, while most candidates have denied being Satoshi Nakamoto. Regardless of who Satoshi Nakamoto really is, on January 12, 2009, he makes the first ever Bitcoin transaction, sending 10 BTC to developer Hal Finney, who is actually one of the candidates to be Satoshi. Fast forward a few months, and the first ever BTC USD rate is established on October 5th, 2009, based on the cost of electricity to produce one single Bitcoin. The rate was $1 equals 1,309.03 BTC, or inversely, 1 BTC was worth just 0.00076, a
Now
fraction of a cent.
66,000.
A few months later, on February 6, 2010, the first ever Bitcoin exchange is established. It's funny to look back to these early discussions and the Bitcoin price predictions these very early adopters were making, where $12 per BTC seemed like something taken out of a fantasy novel. Who could have imagined back then where Bitcoin would be today? A couple of months later, in what would turn out to be a historic event, the first purchase of goods with Bitcoin takes place. Developer and early adopter Laszlo offers 10,000 BTC for 2 large pizzas in the BitcoinTalk.org forum. Someone took him up on that offer and ordered for him the 2 pizzas with a cost of around $25. These pizzas set the first real-life value for BTC at about a quarter of a cent. With today's valuation, those pizzas are worth over $100 million. Definitely the most expensive pizzas ever bought. Regardless, the 22nd of May 2010 was a significant milestone in Bitcoin's history and has since been celebrated in the ecosystem as none other than Bitcoin Pizza Day. On December 10th, 2010, an article on PC World about the WikiLeaks scandal and its inability to get access to financial services mentions Bitcoin as a funding alternative. The next day, Satoshi Nakamoto posts his final words on BitcoinTalk.org. Quote, "It would have been nice to get this attention in any other context. WikiLeaks has kicked the hornet's nest, and the swarm is headed towards us. For a man who apparently values anonymity and privacy, having Bitcoin linked with WikiLeaks at that time seems to have raised a red flag that prompted him to leave the project. As he said in his final email correspondence a few months later, quote, he moved on to other things. On block 210,000, the reward for mining a block was reduced from 50 Bitcoin to 25. As with the limited supply, the halving of the mining rewards was included in the Bitcoin protocol since the beginning to limit inflation and ensure the scarcity of Bitcoins. The halving happens every 210,000 blocks, or approximately every 4 years. And since this first one, we've had 2 more. The second one on July 9th, 2016, and the third on May 11th, 2020. The halvings will continue until the reward drops to 0, when all 21 million Bitcoins will have been issued. And it's expected to happen somewhere around the year of 2140. After that point, the miners will be rewarded only with the transaction fees. Mt. Gox, a Bitcoin exchange that dominated the market until February 2014, when it filed for bankruptcy after it became clear that 850,000 Bitcoins had been lost over 3 years, and several other misappropriations had taken place. At the time, it was feared by many Bitcoin enthusiasts that the incident could bring the death of Bitcoin. Bitcoin has been pronounced dead several times over the years, but this was perhaps the only time that the fears came from inside the ecosystem. Thankfully, Bitcoin persevered as it has always done, and Mt. Gox has since become a textbook example of the importance of not storing your funds on an exchange. As crypto evangelist Andreas Antonopoulos has put it, not your keys, not your Bitcoin. This motto's purpose is to instill the idea that Bitcoin was invented to allow transactions directly between users without the need of an intermediary. In order, however, for someone to do that and to be the true owner of their Bitcoins, they need to hold the private keys used to sign transactions. When users send money to an exchange, they also transfer the true ownership of those funds to these exchanges, since the exchange holds the private keys to the deposit address and not the user. This makes it clear why it's important that private keys remain secret and safe. Private, as the name implies. The private keys sign the transactions, and that signature is the only thing miners need to consider a transaction valid. So whoever controls the private key to an address controls the funds that are in it. And if that someone is anyone else other than the true owner of the funds, then they're as good as gone. Let's get back to our timeline. Currently, Bitcoin can't come even close to competing with legacy payment systems. With a capacity of just 7 transactions per second and a confirmation time of 10 minutes on average, it's far behind Visa's maximum capacity of 65,000 transactions per second, and it's nearly instant payments. Furthermore, because only so many transactions can fit in a block, when the network is congested, fees skyrocket in a bidding war between the users to get their transactions into the next block. So, what's the upgrade that will solve all these problems? The answer: Lightning Network. We'll cover the Lightning Network in another video. FOMO, the fear of missing out, is on full throttle, driving many people to buy Bitcoins at its highest prices. Bitcoin and all cryptocurrencies are definitely highly volatile and have seen many extreme highs and extreme lows. But what many traders like to point out is that after each crash, it settles at a higher low than the previous one.
So, yeah. Any other questions? I think that should bring us to the end of the alt investment section, and that brings us to the end of the session as well. So we're done in terms of MFE 06, right? I think your exams are set for 18th, 2 to 5, no?
Yes, madam.
Yes.
Right. So what we can do is we can either stop here now, and maybe the week before night after your exams. What is the week before? That's like 11th or something, no? Yeah. So that after your Sunday paper, we can have a session, we can have like a 2-3 hour session on past papers, or we can do a couple of questions today and then do a couple of questions then. What do you all want to do?
Prefer on 1 week before the exam. For me, I don't know the rest.
Shall I put a poll out?
Yeah, please.
Sorry. So we say is we do some questions today after the break. And B is to do the questions on 11th, no? 11th.
till the rest vote, on behalf of the entire team, I really wanted to thank for very comprehensive and very detailed lecturing. And I would say rank out of the entire 12 subjects the best we have received in
Thank
terms
you.
of comprehensiveness and the completeness. Thanks a lot, and it's wonderful journey. Thanks a lot.
Thank you very much. Thanks. So we have 21 answered. We are around evenly split, 43% saying today, 57% saying. So let's shall we do like a question or two, and then maybe on the 11th also I'll do a couple of questions. So 11th, keep it open for when do you all want to do, because your exam finishes at 5 o'clock, right?
Yeah.
And it's a physical exam.
Yes.
Yes.
But it's 2 to 5, no? That's the problem. Do you want to do Monday around 7?
That would be the best because some of us has to travel after the exam for a bigger distance.
So let's do that. So Monday, so that's the 12th, around 7-ish, we'll do a couple of questions then. So let's
Thanks
take
a
a
lot.
break. It's 10 o'clock, 10:20 or so. We'll come back, we'll work out a couple of questions, and then we'll do a little bit more questions on the 12th. Okay,
Thank you.
thank you.